Good morning, potentially good afternoon, depending upon where you're joining us from. Welcome to our third quarter, technically speaking, webinar. So I'm Jessica Boycourt. I'm a director in KSM's Technical Accounting Advisory Services Group, which is a part of our audit and assurance practice, and I'm going to be leading us through our topics today as well as doing one of the presentations. So before we get started with our content, we're just going to share a few housekeeping notes. The webinar is being recorded. That recording will be available on KSM's website for on-demand viewing soon after the webinar is over. You will receive the on-demand webinar link in an email. The slides will also be available for download after the event in that email. If you have questions during the webinar, please use the Q&A feature. We believe that we'll be able to see everyone's names when they pop in, just based on that I can see participant names now. But because we had the technical difficulties with Zoom, if you'd like to put your first and last name at the end of your question in the Q&A box today, that will help us out. That way, if we don't get to a response during the presentation, we can still contact you after the event. So as noted, this does qualify for CPE. We use the Conference IO platform instead of polling questions. So you'll need to check in to the Conference IO platform, log in using the QR code shown on the screen, or navigate to the web address listed there. Enter the code words when prompted. You will need to be on the webinar for 75 minutes and enter at least 5 of the 6 code words into Conference IO to receive full credit of 1.5 CPE hours for today. Remember at the end to check out of the session before you leave. We will remind you at the end of the session as well. The CPE certificates will be emailed from our learning management system, LC Vista, in the next few weeks. If you have questions on that, please feel free to reach out to any of us after the event, and we'll make sure that you get the CPE. So with all of that being said, we're going to move into our presentations now. I believe I said this, but again, the Q3, technically speaking, will be the session in Conferences IO to select. Today, we're going to cover 3 topics. So US GAAP accounting for ESOP-owned companies. This came out of a polling response from our last webinar that people were interested in that. How to prepare a statement of cash flows, which is always our favorite financial statement, and then an accounting standards update. So our learning objectives today, you should be able to apply some basic US GAAP accounting concepts to an ESOP-owned company, produce a basic statement of cash flows under US GAAP, and we'll actually have a downloadable Excel tool that you'll get after the webinar as well to help facilitate that. And then you should be able to discuss any recent accounting standards updates and examine any current projects by key standard setting bodies. We will have a plug for the One Big Beautiful Bill, although we have to keep it audit and accounting related in order to award the A&A CPE, but we do have a couple slides in there on how that will affect. First, we're going to make sure that everybody's in on the CPE with code word number 1, which is 781. Again, if you were not on at the very beginning to get the QR code or the link to Conference IO, it's also on the screen here. So check into the session and then you can submit a code word. So 781 is our first code word. If you have any issues with that, please let us know. All right, so our session objectives. First, I'm going to go through the basic ESOP accounting and disclosures for US GAAP. As I mentioned, I'm Jessica Boycourt, a director here at KSM, and I provide technical guidance to KSM clients and engagement teams to help them better identify issues and understand complex accounting and auditing topics. My role is primarily focused on compliance measures such as internal quality reviews, technical training, and resource development. I do sit on our ESOP industry group, but more so from the technical side than from the practical side. But that's why I have the pleasure of talking a little bit about ESOP accounting today. So first, we're just going to do a basic introduction to GAAP accounting concepts, as well as the critical GAAP disclosure requirements that are needed for compliant and transparent financial statements. So whether you are new to ESOP accounting, whether you've never heard of an employee stock option plan, or if you just need a refresher or considering an ESOP, hopefully this will help you understand a little bit more about those topics. So why start with the GAAP accounting? I mean, I think ESOPs, a lot of times there's tax reporting consequences. It's part of a greater kind of cultural shift for a company and looking at compensation and overall benefit practices. So just knowing, I think that the GAAP accounting can be a little bit different and show maybe a different operational impact on the face of your financial statements that maybe is not directly linked with all of those other benefits that you get from becoming an ESOP company. So this is more focused on that compliance and kind of reporting to kind of go hand in hand with your whole ESOP story. In general, there are two types of ESOPs, a non-leveraged ESOP and a leveraged ESOP. So we're going to talk about those a little bit to just kind of set the baseline. So a non-leveraged employee stock option plan is an ESOP that has no debt related to purchasing the shares. So when the company purchases the shares from the sellers or the original owners, they don't use any debt to do so. Under that model, they're more similar to the accounting for other profit sharing plans, so non-ESOP plans, but any other profit sharing plan that you could have. In terms of when cash is contributed to the ESOP, that's a retirement plan expense that's recognized at the average fair value of the shares on the financial statements. The other kind of ESOP is actually more commonly seen as the leveraged ESOP, where there's debt financing used to purchase shares of the company. And then over time, as those shares, as the debt is paid down, those shares that were purchased are allocated to the participants. So as you can tell, that's probably the more complicated, complex type of ESOP because there's a little bit more moving parts. We're going to focus on that leveraged ESOP structure because of the additional complications and the more prevalence there. So the screen has a basic leveraged ESOP structure on it. And if you are familiar, KSM is an ESOP itself, but we also have a great ESOP group that I took this out of their marketing material. So I need to give our marketing team and our ESOP team credit for this graphic, but I think it's kind of simplifies how the transaction normally flows. This might not be every structure because it would depend on where those loans are flowing to and from. Sometimes instead of this arrow 1, the outside loan flowing here, that could be a direct loan from the bank directly down to the ESOP trust. That's a little bit different accounting. And would be called a direct loan, but we're going to focus on this one where we have an outside loan with a third party and then an inside loan between your company and the ESOP trust, which is helping to fund that share purchase. A leveraged employee stock ownership plan is accounted for as a share-based payment plan under ASC 718. There's -40, which is a separate section of US GAAP. Different countries do not recognize the US GAAP ESOP structure, that benefit plan structure, as a separate legal entity. So if you do have the case where you're an international company, this could also look a little bit different in terms of the accounting. So that just remember that as well. We have had that in the past here, but this is going to be only for US based companies that are setting up a US based ESOP. upon inception, that ESOP trust is going to be consolidated with the sponsor. And so this inside loan that we see here in number 4 will eliminate out. And that's where we're getting the contra equity account that's called unearned ESOP shares. So this graphic is really showing that flow of debt as well as the stock purchase for day one. Generally, the transactions would flow as follows. The company is going to borrow from an outside bank. That would be arrow 1. Arrow 2 is the debt payments that'll be paid back. Typically, there's no payment on day 1. There could be, but that flow of cash back to pay the bank back would be in arrow 2. The accounting for this outside loan is going to be the same as any other debt that you would have with a bank or another third party, accounted for under the terms of that arrangement and, the standard borrowing terms there with whatever the interest rate may be. So the transactions at the top of the page are not different under an ESOP transaction than they would be with any other debt that you have with a third party. Where it starts to get fun, or some would say interesting, is when the company then has to loan that money to the ESOP trust, which generates cash for the trust that they can use to purchase the stock from those sellers. You'll notice here that that's going to be the intercompany. They'll have a cash transaction, which generates this inside loan that offset each other. And while there's no asset or receivables on the company's books, that's where you have the contra equity account that's representing the amount of the stock owned by those sellers that's sitting in that ESOP trust. So the last part of this transaction would be when those current shareholders of the sellers are selling whatever percentage of their stock in the company to the ESOP trust, who will now be the new owner. And that you can see kind of how the cash flows through the orange arrows here. This transaction down here between the ESOP trust and the seller is not directly recorded on the company's financial statements because that's an outside transaction between the sellers and the trust. However, that new ownership of the company through the ESOP trust will be disclosed in this transaction and then does drive the accounting that's behind the share release and what the compensation expense is moving forward. That was a lot of information. Give it a second to digest. Probably clear as mud still, but definitely reach out if you have specific questions. So next we'll look at kind of what happens after that initial transaction is set up. So the ESOP has been formed, you're moving past day 1, and there's going to be additional transactions between the third party bank, the company, the ESOP trust, and now instead of those outside the sellers, which was the original shareholders, will be any of the ESOP beneficiaries, so the employee owners of the company. So now we're going to talk about outside of what they might be doing with the retirement contribution loan repayments that are noted here in the graphic and the shares released. The first item is that there could be dividends and or distributions that are really outside of that one-time retirement contribution or the general share release over time to repay the debt. Dividends used to service any ESOP debt will reduce retained earnings unless they're allocated to participants, in which case they are compensation costs. So if you think about it flowing to the beneficiaries, that would be part of that retirement cost or compensation cost on the income statement. And that's because the employers are going to control the use of the dividends on the certain shares. They will not be considered dividends, just like you would typically account for dividends if it was not in an ESOP structure. We're going to talk about the retirement contributions, bullet 2, and the unearned ESOP share release, bullet 3, in the next slide, just because there's some additional clarity that needs added there. We don't talk about that direct loan, as I mentioned earlier, but if you do have that, the accounting is a little bit different when the ESOP trust is directly paying the bank back and forth when the shares are released. It's a little bit different. So we're going to skip that for today. So the share relief, which is going to be, again, a repeat kind of the prior graphic, where step one would have been arrow one in the prior slide, when the trust receives a cash contribution from the employer to fund the inside loan payment. That's going to go hand in hand with step two of the share reliefs, which is when the trust turns around and repays the debt to the employer or the company. So yes, this is a back and forth of cash. Yes, between the same two entities, generally happening on the same day, generally annually in the last month of the company's fiscal year. So a lot of people are like, well, why do we need to do this? Well, in order to make sure that we're repaying the loan correctly and the cash is moving back and forth, these transactions do happen. So it seems like a wash when you're looking at it, but in order to repay the debt, that's how it would functionally look. Step 3 and 4 are also related to arrow 4 on the prior graphic, which was the share release. So we're going to go through 3 and 4 kind of together. So step 3 is where those ESOP shares are then actually released to the participant based on the release schedule. So what's the release schedule? Well, during each period that the employees render service, they have shares released to them based on the schedule that was calculated at ESOP formation. And on the next slide, we'll talk about the 2 ways to do that. But basically, over time, you're releasing those shares in accordance with where you're paying down the debt so that they're then earning those shares. That schedule is kind of set. You could think of it as like a debt amortization schedule, if you will, that allows those shares to be released over time as the debt is being repaid. For step 4, the way you get to that compensation expense number and equity adjustments is when you do the valuation, but third-party valuation at the end of the year, and recognize the ESOP compensation expense, which is equal to fair value of those shares that are committed to be released per the schedule. You'll also reduce then those unearned ESOP shares at the historical cost that they were sitting on the balance sheet. So this is going to be the adjustment to equity that's noted, that's relating to the historical cost of those shares held. Since they're earned back at fair market value, your difference there between the expense and that equity adjustment of the cost value, you'll have a entry to common stock or additional paid in capital for that incremental change or excess, we hope, of the fair value over the cost. I know that's a lot. It's very confusing. When you see it happen in practice, it's a little bit easier to visualize, but that's kind of how we get to those numbers. That ESOP compensation expense that's recorded is part of operating income on the income statement, and if it's material, it should be presented separately per GAAP. So I alluded to in step 3 that there's a couple ways that shares are allowed to be released. So there's a couple different methods. We won't walk through exactly what those methods are in terms of the calculation and the spreadsheet. But there's 2 different methods that are allowed for under ERISA. Again, the schedule that calculates this would be created at ESOP formation, much like the amortization schedule for debt. In practice, we typically see the principal and interest method being used, where shares are released evenly over the life of the inside loan by multiplying the total shares in that suspense by current year principal and interest payments over that total remaining principal and interest payments. So this won't change over time. It's like amortizing them off. You're also allowed to use a principal only method where the shares are released using a ratio of the principal paid on the loan. We don't see that as often. Again, this would be calculated, and then annually you would have a similar release. Kind of to wrap up the accounting is, and this is only balance sheet presentation, but if you had a leveraged ESOP transaction before the transaction, we're kind of showing the balance sheet here. You'll notice in liabilities and equity is where you're going to see the change. If you had the exact same company on day one, after a leveraged ESOP transaction, that third party debt is going to come on as a liability, just like all other debt. And then presenting that unearned ESOP shares, which is the amount that was purchased from those sellers from the trust, is represented there. That's required to be presented separately on the balance sheet. Over time, as you're adjusting for the fair value of the shares and the buyback of the release of those shares, as the debt is paid down, that's where you'll see the adjustment in equity and unearned ESOP shares that will correlate to compensation expense on the statement of operations. So we have code word 2, which is 775. If anybody's not yet logged into Conference.io, there's the QR code and the link on the screen for that, but code word number 2 is 775. Let's go ahead and submit that. I'll give you a couple seconds. We do internally have plenty of other resources for this ESOP accounting and plenty of experts that can walk through those share release calculations as well with you. So, all right. The next piece that I'm going to talk about quickly is just GAAP disclosures. And I think this is an area where it provides additional context to what happened in the transaction, because sometimes, as you can tell, what the numbers show maybe doesn't mean very much without some context. However, there's a lot of text on the rest of these slides, and I know that's not exactly user-friendly. It's not best practices for presenting. You will have these slides afterwards, and I've color-coded the boxes with the example disclosure to give you a little more help in distinguishing what kind of we're talking about here. These disclosures do apply to all ESOPs, so whether they're leveraged or non-leveraged. The guidance in subtopic 718-40, when it was first implemented, ESOPs existed prior to that and they had different requirements. Those actually were grandfathered in, so I don't see that in practice very often, but these disclosure requirements would be only for the recent ESOPs. So just if you do have that situation, know that the disclosures are a little bit different. And then we have excluded any disclosures related to earnings per share calculations, because private companies are exempted from disclosing those items. So the first disclosure requirement, it's a lot of words, but basically description of the plan, how you determine contributions, the employees groups covered, and any kind of the nature and effects. So this is kind of the general what's going on in the plan. This would be similar to what you would disclose for any benefit plan, 401k or otherwise. The second one is that basis for releasing shares and how any dividends on allocated and unallocated shares are used. So this would be for leverage stock option plans only, because that's where you're going to have the share release. So this would be describing basically what you did in the accounting that we just walked through. Third is a description of accounting policies for any of the ESOP transactions, which is required for any significant accounting area to disclose the accounting policies. So this is just an additional disclosure there. The amount of compensation costs recognized during the period. If this is not presented separately on the face of the income statement, or if it includes additional contributions, maybe outside of that debt release payment, then you'd need to disclose that separately, if not on the income statement. The number of allocated shares, committed to be released shares, and suspense shares held by the ESOP at the balance sheet date, along with the fair value of those unearned shares, all at the balance sheet date. And then last is the existence and nature of any repurchase obligation, including disclosure of the fair value of those shares allocated, which are subject to any repurchase obligation. Again, a lot of words. And I'm going to quickly kind of go through the next couple where it has the example language of what that would look like, color coded to kind of the orange, they're the requirements on the prior slide. So this orange is really the description of the plan. This will change depending upon how the employee stock ownership plan is written. The yellow box was the one that was just for the leveraged ESOPs and any pension reversion ESOPs. That has a little bit more about how those shares are released, talking about how they are related to that inside loan, that debt that was recorded as part of the transaction. Next is the description of accounting policies. Sometimes this will be housed in a separate footnote. We like to keep it all in the note with the ESOP just to be consistent, so you're getting all the information in one place, but could be located separately, but talking about how they're measuring compensation and what is happening with the dividends. Then we get into the compensation expense here. This is the example from the FASB guidance, and they were presenting 3 years for some reason. Typically, you would only have this amount for any income statement period presented. The red is the number of allocated shares, committed to be released shares, suspended shares at the balance sheet date. Again, comparative for all years presented. And then the dark blue box is the fair value of those unreleased shares based on what the share price was at the time. You'll notice there's not a gray box that goes through the repurchase obligation and the fair value of the repurchase obligation, partially because FASB doesn't have an example for that. But also because there has been some discussion with the FASB recently in their agenda consultation about what do we need to do with that disclosure to make sure that the disclosure is transparent, because it's not consistently being disclosed amongst ESOPs. So some additional considerations as you're working through ESOP transactions and those disclosures. The second one I mentioned was that it's kind of become an emerging issue for standard setting bodies and having a need for disclosure transparency, as well as double checking that the guidance for ESOP transactions is actually still relevant. There has been an uptick in ESOP formation over the past years, similar to an increase in private equity funding. It's just kind of the trend now that we're seeing. As there are more ESOPs, the standard setters are looking at what is the right way to account for this and what are the disclosures that we need. It's on the private company council's agenda, as well as the FASB's agenda consultation for things that they are likely going to be as priority items that they're likely going to be looking at in the near future. Also note that there are some possible additional disclosures for more complex areas of ESOP transactions that are actually housed outside of the ESOP guidance, because it relates to the debt agreements, any additional stock option plans or employee compensation plans that are related to the ESOP but are presented that are not covered in that guidance. So warrants, stock appreciation rights, put options, that's all housed in a separate area of GAAP. Those are not, they are common in ESOP transactions, but it's not part of the ESOP guidance. We do plan to talk about warrants and stock appreciation rights in November. And lastly, if you are in the scenario where you also have an audit, the materiality used by auditors could also change what's disclosed or how things are presented in the financial statements, just depending upon if it's a significant enough transaction. In general, ESOP transactions will be significant. It's a change in how the ownership structure of the company. So likely you will have these disclosures, but there's always a case here that there could be some past presentation or disclosure items if you are having an audit. So that hopefully demystifies ESOPs a little bit. I think it probably just gave everybody a headache, but that's okay. We're going to move on now to the next code word. If you have any questions on that, please reach out to me. But code word number 3 is 277. I'm gonna go ahead and introduce Andy while this is up on the screen for a second, but our next presentation I think is going to be my favorite one for today is the producing a statement of cash flows. And we have Andy McNeely here with us to discuss this. And again, as I mentioned earlier, we will have a practical downloadable resource that you'll get afterwards that can hopefully help you create a meaningful statement of cash flows. So Andy is a director in our audit and assurance services group. He works with clients to help minimize risk, maximize efficiencies, and ensure accurate financial reporting. He serves a wide variety of businesses and industries with an emphasis in construction. He also has experience in corporate accounting and not-for-profit service, having previously worked for a professional development company and campus ministry in Bloomington, Indiana. So I would like to welcome Andy today to talk about the statement of cash flows.
Well, thank you, Jessica, and hi, everybody. I know technically speaking is not nearly as riveting as the New Heights podcast with Taylor Swift. You got to wait a few more hours for that later today, but it's the next best thing, right? So for this section, we're going to talk about statement of cash flows. On the agenda, it's why, what, and how. Why do it? What are the key components? And then how to actually go about preparing one. As Jessica said, there's going to be an Excel template made available in the post-webinar materials that you can download, make it your own, and use it. And the challenge there at the bottom is for all the CFOs, controllers, financial accounting managers out there. If producing a cash flow statement is not part of your regular monthly or quarterly closing process, the encouragement is give it a go. Try preparing one, and as with all things in life, right? The more reps, the better you get with it, the easier it'll become, and the more it's going to make sense. So let's dive into the why. 3 overall reasons on why: increased visibility, enhanced understanding, and then earlier identification of yellow or red flags. So the experienced CFO or controller out there can usually have a good pulse on if cash is low, why? Like they can look at a balance sheet and look at the P&L and kind of read between the lines and see, okay, what's going well or what's not going well in the business. But there are other stakeholders, namely those in operations or board of directors or other, just people with non-financial accounting expertise that aren't going to be able to look at a balance sheet and P&L and be able to answer, well, why is cash feels low, it feels off, it feels like we're not having a good year. Why? That's where the statement of cash flows can really clearly show those non-accounting experts what's going on in the health of the business. Where are we doing well? Where do we need to pull back? Are we CapEx heavy? Are we CapEx light? Uh, how are we managing our debt? Uh, how are our operating activities doing? All those things are going to be more clear by using and producing a regular statement of cash flows. And then on that last bullet point, identifying yellow flags, we see it every so often when we're auditing a company where there's positive net income and yet negative cash flows from operations. Now, that can happen with accrual accounting and different adjustments, but it's not sustainable in the long haul. You really don't want 2, 3 years of negative cash flows from operations and yet positive income. Eventually, those economic realities are going to catch up with you. And so the earlier you can see and address, okay, why are our cash flows from operations not as strong as we want them to be? The earlier you can spot that, the quicker you can do something about it. There comes a question though, like, hey, why take the time to learn it if AI can do it? This graphic, by the way, was generated out of ChatGPT. We've got the enterprise version at KSM, and I'm using it more and more all the time. And so I did a little experiment where I took a sample balance sheet and P&L and then plopped it into ChatGPT, and here was the prompt. Please prepare a cash flow statement using the balance sheet and P&L. Ask me questions for clarity of any amounts that you're unsure of. And so a couple of observations here. Number one, the AI did ask me really good questions. It asked things like, what was depreciation? Were there purchases of PP&E? Were any fixed assets disposed? Was any equity issued or redeemed? Was there any new debt borrowings? Um, I was only able to answer the questions that it asked me because I had already prepared a cash flow statement on my own. So I knew the inputs. Second observation, the AI did not ask me everything it should have. It asked me a lot of good things, but it didn't ask me everything that it needed to. And I wouldn't have known that it was missing questions had I not taken the time to learn how to prepare a cash flow statement myself. And then third observation, when the AI generated a cash flow statement, it was very confident that it was accurate, and yet it also acknowledged it doesn't reconcile. And to the AI, it's like, it's probably due to this, that, or the other, but no big deal. But of course, right, for accountants, if it doesn't balance, we know it's not right. So I think the implications are is that AI is surely going to keep getting better with this, but for now, I think its utility in preparing cash flow statements is a little bit mixed. And then personally, like the cash flow, think of it really as just one big puzzle. So if you like Sudokus, if you like doing picture puzzles, I mean, this is the same thing, just a big number puzzle. And understanding how to solve that puzzle and prepare a cash flow statement is really going to help your understanding of how the overall financial statements like gears interlock and integrate together. So that's on the why. Let's move to the what. The big components, no big revelations here, right? We got three classifications: operating activities, investing activities, and then financing activities. I think the bookworm definitions of investing and financing activities are more like hard to grasp and understand. It's easier to give examples to capture these. Investing activities are things like purchasing and selling fixed assets, purchasing and selling, investments in debt, equity securities, other businesses, that kind of thing. Financing activities would be new borrowings or repayments on debt and line of credit, or issuing or redeeming equity. Operating activities, the actual definition in the guidance is like a catch-all definition. Operating activities are defined as things that aren't investing or aren't financing. So practically speaking, I think this is a key slide to try to remember in trying to research and prepare for this presentation. This was like a light bulb thing for me. Investing activities, starting in the middle there, investing activities are changes in assets that don't affect net income. So when I buy a piece of equipment, I'm trading an asset of cash for this piece of equipment. So there's no net income impact. That's investing activities. Financing activities are changes in liabilities and equity that don't affect net income. So when I'm paying down debt, I'm just netting down my balance sheet. I'm trading an asset to reduce a liability. Operating activities are changes from all three areas: assets, liabilities, and equity that determine net income. That I think was for me a real big key here. For a lot of areas, it's going to be pretty easy how you should classify things on a cash flow statement, but there are some gray areas. There's some areas that are not as intuitive. This, I think, is a really good North Star on how to determine where things should be classified. Some common wrinkles to iron out. We just talked about the first one, which is determining proper classification. The next one is gross versus net. It's easy to just net things down, but the guidance does say, hey, when possible, keep things grossed up. That's particularly important in investing and financing activities. In operating activities, there is an exception where your changes in working capital can be netted together, but in general, strive for gross presentation in investing and financing activities. Next is the direct versus indirect method for cash flows from operating activities. In 9+ years of doing this, I don't think I've ever personally seen the direct method being used. I know it's out there, but it's rare. I think it's rare for two reasons. Number one, if you do the direct method, the indirect is still required. So most entities just take the path of least resistance and use the indirect method. I think number two, it's the indirect method is a bit more intuitive since you start with net income and then make adjustments to go to cash flows from operating activities. Next wrinkle is like determining, hey, what actually is cash? So we've got cash, but then cash equivalents. So the guidance says that cash equivalents are short-term, highly liquid investments with original maturities of 3 months or less. A lot of times there can be a temptation to put 1-year investments or 6-month or 9-month investments and have that grouped with your cash general ledger accounts. But really, there's a good chance that those should really be considered investments. Still a current asset, but not a cash equivalent. Restricted cash is another area. Restricted cash is cash that is restricted as to its withdrawal or usage. So if you've got some escrow cash account, for example, The restricted cash needs to be factored into your cash flow statement. It's going to reconcile cash, cash equivalents, and restricted cash. And then you just add a little breakout at the bottom to show what's cash on hand versus restricted cash on hand. Business combinations, we're going to deal with an example for that later on, so I won't say much here. Distributions from equity method investees. So a lot of times if you're investing in a joint venture and you get distributions back, it's like, well, how do I code that distribution? Is it an operating activity or is it investing activity? And there's a couple different methods on how to account for those. I think the easiest one conceptually to grasp is if it's a distribution, if it's a return of the investment, investing activities, meaning you've invested in an entity and then now they're distributing that investment back. It's a return of your investment, investing activities. If it's a return on investment, meaning you've invested in an entity, it's been profitable, successful, its equity is growing, and then it distributes some of that equity to shareholders or to owners. If it's a return on investment, operating activities. Finally, we've got non-cash investing and financing activities. These are required disclosures on the cash flow statement. We'll see examples of these. It's very common in fixed assets and debt. Last on this what section is here's just a visual of what it looks like. So on the left side here, notice we've got using the indirect method, we've got operating activities, and on the right side, we've got our investing, financing, and then supplemental disclosures there at the bottom. On the left side, I want you to notice that in determining cash flows from operating activities, there's really two sections, right? We start with net income, and then we've got these adjustments like depreciation, gains, losses, et cetera. And then we've got changes in operating assets and liabilities, which are typically working capital accounts. The first section, though, when you think about like, well, why are these accounts listed up top? It's because when we're trying to reconcile a change in PP&E, there are plenty of things that are investing activities, buying and selling equipment. But depreciation, well, that affects net income. And remember, our rule is if a change affects net income, operating activity. And that's why you have depreciation, gains, losses, and other carve-outs as adjustments to net income. We'll pause here for a code word. It's number 4, and it's 567. Okay, last section, but this is where we're going to spend the bulk of our time. It's trying to tackle on a presentation format of how to actually go about preparing a statement of cash flows. Again, there's going to be a template you can download where all these screenshots are pulled from. But I'll walk through the steps. It's 6 steps. The crux is going to be step 4. The first 3 are relatively straightforward in setting it up. Step 4 is how to actually reconcile the accounts. So that's where we'll spend most of our time. Step 1 is if you can picture you've got your internal financial reports, you got a balance sheet tab and a P&L tab on a spreadsheet. Step 1 is just add a cash flow tab, which is your deliverable, and then a worksheet tab. The worksheet tab doesn't need to be pretty. It's just where you're going to do all your working copies of reconciliations. So step 1's easy. Step 2, on that worksheet tab, copy over all the balance sheet accounts using cell references. But the gist is you want to try to keep it as short and concise as possible. So you want to combine current and long-term classifications into one line. Cash flows doesn't care, if debt is current or long-term or if a note receivable is current portion or long-term. Just cares what's your cash flows from debt. So when we're doing our worksheet tab to prepare the cash flows, condense your balance sheet. Don't worry about classifications. Step 3, add a column to recalculate the change to cash. And one of our principles is going to be we should always reconcile changes from the perspective of cash. So when you think about when I buy when I acquire fixed assets, well, that makes fixed assets go up. But from the perspective of cash, that's a cash outflow. So positives and negatives mean positives is cash inflows, outflows is negative changes. So not debits and credits, and always from the perspective of cash. Visually, when I'm setting up a cash flow worksheet, I always think about receivables and payables. So if receivables go up, that means my customers are not paying me. and my cash goes down. That logic is going to be true for all your asset accounts. So think about it with AR, get the change going the right way, the sign going the right way, and then copy that formula all the way down on your assets. The key is the formula is going to switch for liabilities and equity. So think about AP. If AP goes up, that means I'm delaying paying my vendors, and therefore my cash is increased as well. So the formula flips, but that logic is going to be true all the way down for the change in liabilities and equity. Step four is the crux of the matter. So step four is leave a tick next to each change in cash, and you can see kind of a visual of what this would look like, and reconcile the changes. So CF, that just means, hey, this is going to go directly to the cash flow, tab, and then ticks A, B, C, etc. Those are going to be changes that need to be reconciled. Reconciling principles and how to actually go about this in step four. We've talked about this one. Always, always, always reconcile from the perspective of cash. If you don't, there's a chance your signs are going to start going the wrong way, and it'll be very hard to troubleshoot. If you're not balancing, it's going to be much harder to troubleshoot what's going wrong. Memorize this rule that losses are add backs, gains or subtractions. Losses or expenses or add backs, gains, non-cash income or subtractions. Memorize the rule, but the why behind the what there, I think is easiest to see for depreciation. Depreciation is a charge to net income. So it lowers net income, but it has no bearing on cash. Therefore, it's an add back. That's the easiest one, I think, to conceptualize. But if that's still fuzzy, just memorize the rule. And again, we've got cash inflows positive, outflows negative. On the right-hand side of this screen, principle is that every change on the balance sheet must either go directly on your cash flow tab, or be reconciled on the worksheet tab with the different recon items going through to your cash flow. The premise here is that the change in cash is equal to the sum changes of everything else. The change in cash is equal to the sum changes of everything else. Therefore, I have to consider everything else on the balance sheet in order for my cash flows to balance. Strive for gross presentation and investing in financing activities. And then if you got multiple entities or consolidated and you're trying to do a consolidated cash flows, two ways to go about it. One is if you already know like consolidated depreciation, consolidated debt borrowings, you can just enter one single recon column. If you know it by entity though, it's easiest just to add a reconciling column for each entity, for each area of the balance sheet, break it up into smaller chunks, and then the change going to the cash flow statement is going to be the sum for all of those entities. These are the common areas to reconcile. So the common areas that are going to need tick marks on that worksheet tab. We're going to take these one by one on the following slides. So first, this one I think is the easiest to conceptualize always. It's PP&E. So notice there's three buckets of additions in this example. I paid cash for some additions. I also financed some additions through debt. And then I also got some trade-in values for some additions. The signs are all negative because at the end of the day, these are outflows. It's just some are cash, some are going to be non-cash disclosures, and hence the DISC tick mark. Depreciation expense is an add back. Gains are subtracted, losses are added back. And then proceeds from cash, we have cash proceeds, which is an inflow. And then we also have trade-in value proceeds, which is an inflow as well, but it's non-cash. The goal then is when you add all those up, okay, I've got a 14,760 change in PP&E. Does that reconcile back to my change in cash column? And you can see when those reconcile, you know, PP is good to go. And then you move on to the next area on the balance sheet. So next is debt and lines of credit. A bit more straightforward here. Debt, we're going to do gross presentation. So borrowings are cash inflows, repayments are cash outflows. The only unique wrinkle with debt on this one is going to be we've got some debt incurred from an acquisition, which we're going to talk about later, but that'd be a non-cash disclosure item. So you can see the end goal again is to say, okay, line of credit borrowings, that had a net change of 500. And then long-term debt, both current and non-current, had a change of 5,500. I want to reconcile those changes in the breakout. Once those reconcile, you're good to go and you move on to the next area. For operating leases, there's a couple of different ways to present these on cash flows. I think the easiest one is to just net the two. So take your operating lease right of use assets, the change in that, take the change in operating lease liabilities, net them together, and that's going to be your change in leases, your net change in leases, and take that directly to the cash flow statement. If you have financing leases, how you reconcile those is going to be very similar to the previous slide when you're reconciling debt. The terminologies are a little bit different, but in general, finance leases, when you're reconciling that change, very similar to how you'd reconcile debt. Next, we've got equity. So equity, the recon items are net income, contributions, distributions. If you're an ESOP, like in Jessica's slides talked about, there could be non-cash ESOP comp expense. Well, that affects net income and it's non-cash. And so that can be an adjustment to operating activities. But in general, we've got contributions and distributions. With distributions, a common area we'll see is that there might be accrued distributions on the balance sheet. So in this example, we can see that total distributions were 7,110, but there's a change in accrued distributions of 2,000. So therefore, we have to, again, break out that change in accrued distributions, and really cash paid for distributions is 5,110. Next, we've got receivables. In receivables, with the new CECL guidance, current expected credit loss model, the guidance does say, hey, if it's material, break out your credit loss expense separately on the statement of cash flows. So here all we're doing is saying, okay, here's our credit loss expense. Think bad debt expense under old GAAP. And then the change in receivables is everything else. Investments, we've got proceeds from the sale of investments. That's a cash inflow. Purchasing investments is a cash outflow. And then you've got gains and losses that'll go on the cash flows from operating activities as well. Second to last, we've got other assets, right? Which is often just a hodgepodge of different assets on the balance sheet lumped together. So if the balance in other assets or the changes are not significant, it's likely okay to show net on the statement of cash flows. But in general, when possible, strive for gross presentation. In terms of how to classify it, generally speaking, the preferred presentation is within operating activities. There are some exceptions to this. So suppose that a big chunk of your other assets is like a life insurance policy on a key executive. You got a cash surrender value on that. Well, if you're paying premiums on that policy, that's an investing activity. Think about this. You're exchanging one asset for another asset. You're paying cash, but you're getting this surrender value. If instead, though, you are doing a yearly true up for the cash surrender value, it increases in value every year, but there was no cash paid. Well, again, that's a P&L impact, and that should be shown as an operating adjustment. Finally, we're going to spend some time on this one, how to handle acquisitions from business combinations. The first bullet point there is if a combination is determined to be an asset purchase, no recon necessary, meaning we don't need a separate carve out on our statement of cash flows. That determination though, like, hey, am I acquiring a business or is it an asset purchase? That's a very technical question in and of itself. We've had past presentations on it. I'm sure we're going to have future presentations on it, but know that that is not always a straightforward question. Am I buying a business or am I getting a bunch of assets? Take it at face value, though, that for purposes here, we're going to assume, yes, it is a business combination. And so if it's determined to be a purchase of a business, we reconcile assets acquired and liabilities assumed to the total consideration of the purchase price. So 3 mini steps in this process. Number 1, input the acquisition date values into your cash flow worksheet. So not the year-end values of the entity acquired, but the acquisition date values. Tweak that changes to cash column to back out those acquisition values, and then reconcile your net assets acquired versus consideration of the purchase price. So visually what this looks like here, I've been ignoring this acquisition column in the previous slides to save it for now. Here's where we deal with it. So look at receivables. Receivables went from 6 to 10. So the change was 4, but that's due in part to 300 added from an acquisition. So when we back that out, the net change to AR is 3,700. And if you go down to AP, the change in AP went from 13 to 15, so a change of 2, but that's due in part to 220 from an acquisition. So the net change to AP backing out the acquisition is 1780. So step 1 is input the assets acquired, including goodwill, and the liabilities assumed. Step 2 is tweak that changes to cash column. Step 3 is when we look at, okay, total assets acquired 1060, liabilities assumed 220. So our net assets acquired is 840. Step 3 is going to be how do we take that 840 and break that out to total consideration of the purchase price. So in this example, we've got 275 was paid out in cash. So that's going to be on our cash flows from investing activities. But then we incurred some debt. Well, that's a non-cash disclosure. And then we also have some contingent consideration, which is going to be a disclosure as well. That contingent consideration, like suppose it's some earnout provision. So that's buried in accrued expenses. So once again, now we need to reconcile accrued expenses. Accrued expenses changed 2,500, but 50K of that relates to this acquisition value, this earnout provision. And so the change in our cash flow statement is really the net impact, the 2,450 there. Okay, that's a lot. As I said, step 4, reconcile items. That's the hardest part of this whole exercise. But you know you're doing it right if you can get every single area of the balance sheet to reconcile. Step 5 is then just summarize all your little tick marks where you've got, okay, this would be a disclosure item here and there. Summarize all those, and then also aggregate your cash paid for interest. That one's super easy. You just take your interest expense from the P&L, you add back in accrued interest expense from the prior period, and you back out accrued interest expense from the current period. That'll get you your cash paid for interest. And then, like I said, you aggregate all those supplemental disclosures. Step 6 then, right, it's got the big green check mark. If you've done all that correctly on your worksheet tab, on the actual deliverable, the cash flow tab, you're just doing cell references. You know, you're putting them in the right spots and you're just cell referencing everything with a CF for cash flow. And then if you've always reconciled changes from the perspective of cash, you should never need to flip any signs from the worksheet tab to the actual deliverable. But we all know if only it was that easy, right? If it was always this easy, we'd see a lot more internal financial packages with cash flows included. So the final section here is like, well, what if you follow all the steps and the cash flow still doesn't reconcile to cash on the balance sheet? Even in preparing this presentation, I had to go through that 15 minutes of just like, why on earth does this darn thing not reconcile? And so here are some troubleshooting triage steps when cash flows do not balance. Remember our North Star in all of this. The change in cash is equal to the sum changes from everything else. Therefore, every balance sheet account must factor into the cash flow statement. So 3 troubleshooting steps on the worksheet and 3 troubleshooting steps on the actual cash flow tab. So first the worksheet tab. Number 1, check signs. Every reconciliation should be from the perspective of cash. It's probably the number 1 area where I see issues on cash flows and causing things to not reconcile is because we use a mix of we don't always make the signs mean the same thing. So be consistent. Every recon should be from the perspective of cash. Number 2, go through your balance sheet accounts on that worksheet tab. Every change must be taken directly to the statement of cash flows or reconciled with those cash flow changes and disclosure amounts noted. So make sure you're capturing everything on your balance sheet. And then step 3, check your non-cash reconciling items between areas to ensure they match. So in my case, when I said, hey, even in preparing this template, I was off on my cash flow statement, it was because I had non-cash additions to PP&E, mean one number in one area, but down in debt, it was a different number. Well, they need to match. And so that when I went through my own troubleshooting steps, that's what caught the error. Okay, so those are three troubleshooting steps on the worksheet tab. And then finally, three troubleshooting steps on the actual cash flow tab. So on the actual deliverable tab, number one, check for hidden rows. As you do this month after month or period after period, you might run across like unique one-off reconciling items, and then it's not applicable in future periods, so you just hide the row, but the cell is still referencing something from the cash flow tab. So make sure that no hidden rows are referencing things that they shouldn't. Number two, check for your signs being flipped, because that would indicate that not all recons are from the perspective of cash. And then number three, check that each line is referencing just one cell from the worksheet tab. So that's what I mean in the formula bar. You really want to only see one cell referenced. The more that you're trying to combine multiple things into one line item, the more that's ripe for error. And it can cause, some frustrating differences on why the thing isn't balancing. Okay, we covered a lot of ground. I know that was highly technical. I hope that you guys can review the slide deck afterwards, and that the template that will accompany it is meaningful. Make it your own. Try it. That's the challenge. Try preparing a statement of cash flows after your next closing. We covered why, what, and how, and I thank you for your time.
Perfect. Thank you, Andy. I appreciate that because even after being a CPA for 16 years, if I think my math is right, statement of cash flows is still the one where I'm most likely to say, why does this not work? So whether you've been an accountant for 2 days or 25 years, I think breaking it down is always helpful to, and I do think the template that we'll provide afterwards should be helpful to everyone. Again, reach out if you have any questions. Code word 5 is on the screen. It is 831. Code word 831. My kids are gonna say this is cringy, but I have to do it because the last code word was 567. And if you have a teenager, you're probably sick of hearing 6-7, but I did notice that that was in there. So that's my cringe mom moment, assuming my children ever Google me and watch this presentation, they'll hear it. They won't. So as a conclusion to our technical topics today, I'm going to welcome Amanda Horvath. She is also a director in the firm's Technical Accounting Advisory Services Group. And in her role, she conducts technical accounting research that helps KSM teams and clients resolve technical issues, interpret and apply new accounting standards, and ensure the quality of assurance engagement. Amanda also supports the firm in the adoption of new professional standards, audit tools and technology, and really drives kind of the decisions being made in our audit methodology in her role. So she's going to cover for us today the most recent updates to the FASB accounting standards through the FASB Accounting Standards Board.
Hello, everyone. As Jessica said, my name is Amanda Horvath, and I'll give you a brief standards update today. I'm going to touch on 3 main areas. First, I'm going to cover 3 newly issued ASUs, and then give you a very brief update on current FASB projects, and then lastly, cover how the new tax legislation affects your accounting. Every time there's major tax legislation in the middle of the year, questions come up on this, so we wanted to cover that briefly. The objective of this presentation is to provide an overview of each of these topics instead of a deep dive into the details. It's intended to give you enough information to know if you do need to dig deeper. So for more information, I encourage you to reach out to me or your KSM advisors. So first, those recently issued ASUs. We're going to start with ASU 2025-03. This standard deals with determining the accounting acquirer in a business combination when a variable interest entity, or what we generally call a VIE, is involved. The issue that FASB is trying to address with this ASU is a lack of comparability between transactions involving VIEs and those that do not involve VIEs, particularly when the business combination is affected primarily by the exchange of equity interests. Previously, the primary beneficiary of the VIE was always considered the accounting acquirer, even if that didn't make economic sense. Under the new guidance, a VIE, if the VIE is a business and the equity interests are exchanged, the general guidance under ASC 805 applies. This means that entities must assess control and other factors to determine the accounting acquirer, and those considerations include things like relative voting rights, composition of the board and management, relative size of the combining entities, and the terms of the exchange of the equity interests. This change could result in a determination that the legal acquiree is actually the accounting acquirer, and then that would be accounted for as a reverse acquisition. So this is something that would occur in non-VIE transactions under the current guidance, but not when a VIE was involved. So this should improve that consistency with acquisitions involving and not involving VIEs and better reflect who gained control in that transaction. The effective date for this is for fiscal years beginning after December 15, 2026. Early adoption is permitted and it's applied prospectively, so prior periods would not be restated. Next, we have ASU 2025-04. And this standard clarifies how to account for share-based consideration granted to customers. So think things like stock or stock options or warrants that are being offered as incentives to customers to increase their purchase volume. These incentives often vest upon the customer purchasing a specified volume or dollar amount of goods or services from the grantor. And under ASC 606, consideration payable to a customer is accounted for as a reduction of revenue. So the value of these would be reducing your revenue. GAAP previously lacked clarity and companies were unsure how to handle vesting conditions and forfeitures. In particular, it was unclear whether vesting tied to customer purchases were performance or service conditions. And then that's important because if the condition is a performance condition, you were required to estimate the probable outcomes. So that is whether it's going to vest or be forfeited. And if the condition was a service condition, the grantor could elect to account for forfeitures as they occurred. So this could delay that revenue recognition until that forfeiture occurred. So that was a concern about the economics of that transaction not really aligning up. The new ASU makes three key clarifications. One is that if vesting is tied to customer purchases, it's now considered a performance condition under ASC 718. So this should result in better alignment of the revenues and the incentives. Now, while that means fewer awards would be service-based, they also clarified that if it is service-based, you cannot elect to account for forfeitures as they occur. They must be estimated up front. I do want to note, though, that the policy election remains available for awards and service conditions granted to employees and non-employees in exchange for goods or services to be used or consumed in the grantor's own operations. So this only applies to share-based consideration to customers and not to your employees. So you can still make that election for your employee compensation. And then the third thing they clarified was the ASC 606 constraint on variable consideration does not apply here in this accounting. So you would only apply the ASC 718 guidance in assessing vesting probability. These updates should align the accounting with economic substance, prevent revenue delays from overly conservative recognition, and support clear and comparable financial reporting. This update's also effective for December 5th for periods beginning after December 15th, 2026, with early adoption permitted. And there are two options in transitioning to this new guidance. You could do a catch-up adjustment to retained earnings as of the beginning of the period that it's adopted. So that's called the modified retrospective, or you can do a full retrospective where you're adjusting prior periods. And then you would just adjust retained earnings as of the beginning of the earliest period presented. If you are doing the full retrospective, you should consider the actual outcomes, so the actual forfeitures when those are known, when determining the adjustments. So that means you're not going back and thinking, well, what would we have thought 2 years ago about the probability of vesting? You would actually use the outcomes. And then finally, we had ASU 2025-05. And if you kind of zoned out there because you're like, we don't do acquisitions, especially not with involving variable interest entities. And then we also don't do share-based compensation to our customers. You might want to tune back in because this will impact most everyone joining the webinar because it addresses the allowance for credit losses on trade accounts receivable and contract assets. So a little background here. The FASB received some pretty negative feedback, particularly from private companies and not-for-profits, that the CECL model is overly complex. So some background on the CECL model, which was adopted recently by most of our clients. This uses, so first it uses historical loss rates to determine the basis for the allowance for credit losses, and then that is adjusted for any current conditions and then economic forecasts. So it's originally issued CECL required entities to consider microeconomic data in those forecasts, such as unemployment rates and property values, as part of determining those reasonable and supportable forecasts. So as probably most of you are on here don't have an economist on staff to interpret macroeconomic data, you can see where this seemed really complex for those short-term receivables. And the effort required to actually use macroeconomic data in those forecasts outweighed the benefits. Another thing that private companies complained about was that the CECL model did not allow the consideration of subsequent collections in the calculation for the allowance for doubtful accounts. So that seemed really counterintuitive for most of our client base. And you could have 100% of your trade accounts receivable collected, but if you properly use the CECL model, you would still be expected to have allowance for credit losses recorded. So that just didn't make a sense for a lot of our client base. And frankly, we didn't really enforce it because the difference there would have been either trivial or definitely immaterial if it would have used that accounting model. So ASU 2025, it introduces two things: a practical expedient available for all entities, and then an accounting policy election that's available just for those non-public businesses. And that would include your nonprofits and employee benefit plans. This ASU only applies to current accounts receivable and contract assets arising from transactions under ASC 606. So it wouldn't apply to any kind of financing receivables, debt securities, interest receivable, anything that falls outside of ASC 606, or if for some reason there was some sort of long-term accounts receivable, it wouldn't apply to that as either. And by current, I do want to clarify they're referring to, it's classified as current on your balance sheet, which is generally due within 12 months. It's not referring to current versus overdue. It's the classification on the balance sheet. So let's look into these two items in more detail. First, let's look at the practical expedient, and this is available to all entities, including our public companies. If this is elected, the practical expedient allows entities to assume that current conditions at the balance sheet date will remain unchanged over the life of the asset. That means you no longer need to layer on those forward-looking macroeconomic forecasts for those in-scope assets of accounts receivable and current or contract assets. Frankly, most of our non-public companies were already not doing a full analysis of economic factors, as we knew that any impact on the allowance for credit losses would have been small. You are still required to adjust historical loss data for any known changes in customer behavior or credit quality. And the only disclosure requirement here is that you're using this practical expedient. Next is an accounting policy election that is only available to our non-public business entities, again, including your nonprofits and employee benefit plans. And that is that you may consider subsequent collections after the balance sheet date up to the date of financial statement issuance. This means that whatever that date is that you select to account for subsequent collections through, if you have collected the amount, you are allowed to now have a zero credit loss against that portion of the balance. And then any remaining amount would be evaluated using the aging status as of the selected date. So the next slide shows an example of that. I think it's kind of hard to read and understand what that means, but once you see it, you'll know. And then for disclosure requirements, you are required to disclose the election, that the election's being used, and then that cutoff date that was used for evaluating collections. So this date can be any date from the end of the year up through the date that financial statements are issued, but I would expect that generally that date would be earlier than when the financial statements are issued so that any adjustments can be made through your standard year-end close process, and you're not making last-minute adjustments to the financial statements. So here's the example as promised. This is a snippet straight out of the codification, and it demonstrates the use of that accounting policy election. So you can note here that use of the March 1st date and what they mean by updating it to the aging status as of that selected date. So you see that at least as of 12/31, they had about $6 million of current AR, or current as in not past due. And then they collected all but 60,000 of that. And you see how they rolled that forward to use the credit loss rate for the receivables outstanding more than 30 days to up to 60 days. So instead of using what you would have used as a 12/31, you're rolling that to whatever the current aging status is of the date that you selected. This ASU is effective for periods beginning after December 15th, 2025, and early adoption is permitted for any financial statement that has not been made available for issuance. So that means that if you still haven't issued your 2024 financial statements, you could go ahead and apply this. If you have a junior end, you can go ahead and adopt this as well. And we do anticipate the majority of our clients will early adopt this as of the end of this year versus waiting until next year, because it does reduce the burden of compliance with CECL, as well as just makes the most sense to our non-public businesses. These amendments are applied prospectively, so you don't go back and adjust anything in the prior periods. And one just other thing to note, that if you don't adopt this as of that effective date, so let's say you wait until like 2028 to adopt the private company election, you don't have to do a preferability assessment, so you can just adopt it whenever you wish to. So that's it on the new ASUs. And we do have a code word here. It's 669. I'll give you a second to jot that down or get it into the Conference IO app. And again, that's 669. So quick update on the FASB projects. I think it's always interesting to see where the FASB is spending their time. We are expecting quite a bit of new activity by the end of the year. So several new ASUs that we are still expecting to see, including ones that we've covered in previous webinars, such as the accounting for software costs and the accounting for government grants. So those are probably the two out of the 2005 ones that we are watching most closely. It's also interesting to see some of their other big projects, statement of cash flows, targeted improvements, so that might affect some of the things that Andy said earlier in his presentation. And then the other one we're watching closely is this accounting for debt exchanges. So debt exchanges would be like refinancing debt and how those are accounted for. And then finally, just briefly, we're going to touch on the accounting considerations for new tax legislation. As I said, this comes up anytime we have major tax reform legislation, and how do I account for that? So just quick update, on July 4th, President Trump signed significant tax reform legislation that's commonly referred to as the One Big Beautiful Bill Act. This reinstated several favorable tax provisions. For individuals, it maintained those modified tax brackets and lower tax rates. For businesses, some of the key items include the immediate expensing of domestic R&D, full bonus depreciation, and the favorable interest deduction calculation. It also tweaks some of the international provisions. The effective dates for these are primarily in 2025, but they do vary somewhat by provision. As you may suspect, because I am in the audit department, I am not an expert on the tax bill. So fortunately, we have several people at KSM who are, and I encourage you to look at some of the blogs that they've been writing that are out on KSM's website. There's also an on-demand webinar that introduces the major provisions of the bill. And then tomorrow, there is a webinar for the tax reform's impact on the construction industry. So you can register for that still through our website. So I encourage you to check those resources out. So now back to what I do know, which is the accounting. So for those entities that are required to include an income tax provision, so these would be our C Corps. ASC 740 requires recognition in the period of enactment. So what's important here is that if you have a June 30, 2025 financial or fiscal year end, you are not going to account for any impact of this bill in your income tax provision. If you have a year end subsequent to July 4th, 2025, you will be accounting for that. And for those June 30 year ends, it doesn't matter how big of an impact this is going to have on that provision, you still don't account for it. So that's a little bit of a mismatch. It might not match what's actually presented on your tax return because of that timing of when the bill was signed. We do expect that it would impact all parts of your income tax provision, so your current taxes and your deferred tax assets. It's also important to look at those valuation allowances against deferred tax assets because it could impact the realizability of those deferred tax assets. For disclosures, you would expect to have some sort of disclosure on why your effective tax rate differs from your statutory rate. And then if there's any significant matters that affected comparability, that would be disclosed. For those June year ends, if this is going to have a significant impact on your income tax provision, you should include a disclosure of that as a subsequent event. And if the amount has been quantified, you would want to include that in that disclosure as well. So that wraps up our standards update. We covered those 3 new ASUs, the current FASB priorities, and the financial reporting considerations for recent tax legislation. Please reach out if you have questions, and thank you for listening.
Perfect. Thank you, Amanda, for that. I know we have a question out in the chat, getting that live link shared so that anybody can register on that. We're working on getting that in the chat. If not, when you can navigate to KSM's website and would be able to find that there. So hold tight if you don't see that link pop up in the chat. Reach out to us afterwards. That way you can register tomorrow for the construction webinar. So I want to thank everybody, Andy and Amanda, for presenting with me today, and also thank all of you for joining us. We know there's a lot of webinars going on. There's a lot of information out there. So we appreciate you taking time out of your day to be part of our webinar, especially having technical difficulties. It was nice to see everybody still be able to join us. We do have a save the date for our next technically speaking seminar, which actually is going to be our year-end ANA update. You'll also see that just popped up on the screen a poll for future technically speaking topics. If you do have any other topics, make sure you're adding those in the chat feature. But we use this to kind of generate what our topics are in the future. So please respond to that poll and let us know if there's anything else that you'd like to hear. We do have some content already in the works for November. You'll get registration a little bit earlier for this information and registration in September for the November event. It's a little bit longer. It's 2.5 hours, and we'll provide 2.5 hours of CPE credits. We will also have our tax year-end webinar. I think they're still working on the finalizing a date for that, but you'll see that information also come out in September if you're also looking forward to our tax webinar. We do have a web page available for any resource guides that are provided from our technical accounting advisory services page. You'll get that link, but there's some information up there. We update that throughout the year. Take a minute to see what's available for download. You can also navigate to via our website to the ESOP industry group for information on that as well. As another reminder, if you submitted a question that was not answered, we'll reach out to you directly. I believe that link was shared in the chat for the construction webinar to everyone. So if you want to register for that, that's available in the chat now. CPE certificates will be emailed in the next few weeks for those that entered the required number of code words. Please remember to check out of the Conference IO app as noted on the screen to ensure that your session is complete. If you have any other questions, reach out to any of us directly or directly to your KSM advisor. Thank you again for joining us today. I hope you have a great rest of your Wednesday, and we will see you in November. Thank you.